Welcome to the show. I'm Kim Parlee. So glad that you could join us tonight. Well, the World Bank downgraded global economic growth today to 3%, and that's down from the previously projected 3.4% in June. And that was enough to send stocks and commodity prices sharply lower, building on the losses we've seen in the past little while. Copper prices hitting a new 6-year low. So, if Dr. Copper is hitting a 6-year low, what does this all mean for the markets in 2015? We have some sage, calm advice. Someone who has been watching these markets for a long time and can tell us what he sees right now. Bob Gorman, Chief Portfolio Strategist at TD Wealth, joins us now. It is nice to have you here.
Good to be here.
Okay, calm us all down, if you will. What do you see right now? I mean, every day I feel as though we're getting news of, oil's down again. Actually, oil was up today, but oil's down today and copper's down. Markets are selling off. People are concerned about X, Y, and Z. The U.S. is okay. Maybe it's not. What do you see?
Well, to your point about the Royal Bank numbers, you'd rather have more growth than less, but to lend a little perspective here, this is a reduction in growth. It's not a recession. And the 3% global number is not fabulous, but it's not that bad.
It's not a recession.
It's also kind of spotty because you do have slower growth in Europe, no surprise there, a little slower in China, but the States is in pretty good shape. And interestingly, India is going to be a story for the next few years. So I think what it points to is you've got to be selective going forward. We're not going to have uniform growth worldwide, so that has implications for asset allocation where you put your money going forward.
I should let people know we're going to spend a little time here in the beginning talking about the macro outlook, and then Bob is going to hop into some stocks that he likes, because I know people want to hear about those coming up. But before we do, let's talk about oil. Okay. So oil now down, I think we hit 45 and change today in trading, down from well over 100. What questions should we be asking about oil?
Well, the first point I would make is that at $45, oil is well below the marginal cost of production in most locales around the world. And while commodity prices, including oil, always overshoot to both the upside and the downside, they don't go too far below the marginal cost of production indefinitely. So that's the first thing to bear in mind. And most would put that cost for many producers are in the 60s, let's say. So that's the first point I'd make with respect to oil. Now, having said that, at the same time, the Saudis, who can sustain lower prices, are going to see a budget deficit probably in the order of $40–50 billion in the coming year. And even for them, that is significant. Yes, they can sustain this for a while. They have a strong balance sheet, but not indefinitely. So you put some of those factors together, and it suggests to us that we're probably going to see some further downside here. But at some point, you take a look at the long-term futures, they're in the mid-60s. That tends to be a better indication of where prices ultimately move to. You're probably going to see some sort of recovery as you head into the latter stages of next year.
Recovery
back to where we were, I would say a number in line with that marginal cost of production is probably not an unrealistic figure.
Which is a far cry from the 100 plus that we had before.
Exactly so. So it did spike beyond what I think of as a reasonable figure. But again, I don't think that's unreasonable going forward. So below where we were, higher than we are today. It'll probably take some time for this to work through the system. That is always the case. Prices generally go lower for longer than you anticipate. I don't expect a V-shaped recovery, but this will not hold true indefinitely. Worth remembering at the same time, the TSX Energy Subindex is down about 50% from its peak of last year, and I don't see us gaining traction here in the near term, but if you're in high quality holdings, I would sit tight at this stage. You'll have opportunities later on.
If you have a long-term perspective, like if you've got a 10, 15, 20-year horizon, would you be sniffing around the energy sector?
And I'm not sure you even have to look out that long, but if you're in the higher quality names, some of which we'll talk about a little later on, current prices will ultimately, I think, look fairly good for a number of those producers.
I want to get to, like I said, these picks in just a second, but just in terms of everything that's going on right now, oil, obviously, top of mind for everyone. What else? What else should we be paying attention to that perhaps we're not paying attention to right now?
Well, you talked about GDP growth. GDP growth ultimately translates into earnings growth, and earnings growth determines stock prices over time. So, what do those sorts of numbers look like when you're talking about earnings going forward? For the S&P 500 in the coming year, we've been more cautious than most on the earnings growth front. I think you're probably looking at 5 or 6%. Stocks probably go up something along those lines. You had a few percent Dividend yield, you're probably talking upper single digits for the coming year.
Yeah.
Not bad, and the 7th year in a row the U.S. market will go up, in our view. A very rare event. I think that's sort of a reasonable expectation. So look for the earnings growth. That's going to be very important in 2015.
All right, stay with us. When we come back, we're going to have more with Bob Gorman. He's going to have a few stocks that he likes in this environment. Again, Bob Gorman, Chief Portfolio Strategist at TD Wealth. And a reminder, any comments or questions, we love to hear from you. Send those comments and questions to MoneyTalk@bnn.ca so we can find those answers, answer them for you on the show, or find the right person to answer them for you. More Money Talk when we come back. All right, we are back with Bob Gorman, Chief Portfolio Strategist at TD Wealth. As I promised, it's time now to get some names to match the macro outlook that he's looking at right now. And we should go back again to one thing. Single-digit gains for equities is what you're seeing for 2015.
I think that's right. Upper single digit for 2015.
Okay, so let's just set expectations. In the healthcare space, who do you like?
My favorite name last year was United Health Group. About 36% total return. I still like it going forward. It was underappreciated, undervalued. I think it's still got momentum going to 2015.
But that's a pretty big gain for 2014. That's total return, I'm assuming?
That is correct. And it was, in my view, underappreciated and not well understood. So I think it's reasonable valuation here, but I still see this going up somewhat in the coming year. So a decent number, but not matching last year's.
Okay, number 2, Home Depot. So is this just a play on what exactly?
It's pretty much a play on long-term housing recovery. This has been a favorite selection the last 2 years. So I think 18% 2013, about 30% last year. It's not a cheap stock at this stage of the game. But the housing recovery really has legs, in my view. It's going to be gradually unfolding, and this is going to be very good for Home Depot. Already has been. They're consistently beating the quarterly estimates.
Let me ask you, and I know I can throw you anything because you travel everywhere and talk to anyone. People say shale oil. Let's say that what's happening is prices continue to go down. So many jobs have come from the shale oil industry, have come from, of course, those people have gainful employment, buy their houses, and is there any the dislocation of oil? Could it not disrupt that a little bit, you think?
I think to a degree in those locales, but remember that the U.S. is a net importer of oil.
Right.
Still is. And therefore net benefit to the United States, and in turn more cash in consumers' pockets. This would be a net benefit so far as Home Depot is concerned. Okay.
Cisco.
We looked last year at the old line tech companies that were very, very cheap. Cisco is one of them, total return about 27% or so. Still good value here. I like Cisco for 2015. Similarly, Oracle was inexpensive last year. Return was a little shy of 19, I believe, and I'd still stick with Oracle for the coming year.
Is there anything specific? I mean, these are obviously huge companies, strong balance sheets, huge market share, but is there anything that stands out like really with each one of these that you really like?
Well, they were characterized by very low valuation.
Yeah.
Extremely low PEs, underappreciated, and so we saw little expansion of the PE multiples going forward. Right now what you're seeing is a long-awaited big increase in U.S. business investment.
Okay.
And this is going to be very good for technology because the first way to improve your productivity is technology, so look for both Cisco and Oracle to benefit from that.
Let me ask, and I'm actually not this negative, Nellie, but I'm just going to ask the questions. I'm thinking sometimes if you're a CEO at a company and you see, oil do what it's doing right now, and just volatility, it's the speed of the dislocation. You may stop and go, do I want to spend this? Because there's a lot of things going on. So do you think that could put the brakes a bit on capital expenditures, and therefore, I know this is kind of, I'm pulling things along.
I'm not so sure that's true. If you take a look at U.S. industrial capacity utilization, it's now hit 80%, the long-term average, and typically the point at which CEOs start making decisions about whether or not going to be making investment decisions, new plant and equipment, et cetera. I think that number will stay roughly in line in aggregate, and therefore you will see that long-awaited increase in capital spending. In the third quarter of 2014, we saw that number about 7.1% or so. That is a big number, and watch for that to have legs going forward.
Okay, in the financial space, you like whom? The U.S. financials?
Repeat selection here. Last couple of years, we had both J.P. Morgan, Wells Fargo. They've both done quite well for us. Wells this past year was 23%, I believe. J.P. about 9 and change.
Is that currency as well? Or
no, that's just U.S. dollars.
Which, okay, so.
So, yeah, bonus beyond that. Going forward, I prefer Wells Fargo.
Because?
It's a little more expensive, but first of all, very simple business, largest mortgage originator in the United States, great branch network, strong balance sheet, very strong credit rating. They will ride that housing recovery that we talked about. Mm-hmm. So I like the risk-reward relationship there a little better.
MetLife.
The life insurers, both in the U.S. and Canada, have not done a thing for years,
yep.
suffering from very low bond yields. MetLife is a bit of a special situation. It has been declared a systemically important financial institution by the regulators, too big to fail, more regulation, etc. Now, MetLife is going to challenge this. One way or another, I think it is undervalued, good dividend while you wait, and at some point, bond yields rise, they will benefit from that tailwind. You may have to wait, but I think the risk reward is pretty good.
Okay, this is like a bonus round for people who are watching. We're getting a lot of names in here. I have a lot of happy viewers after this. Let's go for some Canadian names, because again, are you tilted more towards U.S. equities?
We've been overweight in both, but we remain overweight in both.
Okay. Brookfield Asset Management.
Sure. This is a selection from the last 2 years, and it's done very well, 18% total return in 2013, about 43% in 2014. That was a star. Really like the three underlying businesses here. Very high caliber, Class A office space in gateway North American cities, renewable energy infrastructure. After such a run, I would normally be leery. But those three businesses are doing extremely well. I expect them to continue doing so. I don't think we'll match this year's returns or the most recent year's returns, but I still like Brookfield going forward.
Okay, two more I'm going to ask about. Bank of Nova Scotia.
BNS had a modest total return this year, about 3.7%, actually underperformed the group, concerned about Latin American exposure, and that's justified in the current environment. However, it is selling at an unusually significant discount to the premium valuations of Royal and TD. I think over time that valuation gap will narrow.
And why do you think that'll narrow?
Because I don't think over time Scotia is going to do quite as poorly in these foreign operations as sentiment would currently suggest.
Okay.
Meanwhile, you've got a good dividend yield, about 4.3%. You're paid to wait, and I think over time that gap narrows.
Suncor is on your list.
Suncor, yes. This is the name I studied in the energy sector for a long time. It's outperformed in good markets and bad markets for energy. Has held up relatively well. Now, Suncor is a fairly low-cost producer. They've shown good discipline so far as capital allocation is concerned. And going forward, I think they will do relatively well and come out of this in pretty good shape. Good risk-reward relationship in the energy group, Suncor.
Last one. I don't think I've ever had this many picks on a show before. Like I said, this is incredible. Okay, tech.
Tech.
So on a day where copper is doing what it's doing.
Yeah. Now, most of the stocks we hold are the less economically sensitive dividend growth stocks. But if you're looking at metals, tech has been, like many others, severely beaten up. It is copper, zinc, metallurgical coal, obviously under pressure. But it does come with a pretty strong balance sheet. Dividend should be fairly solid at current levels. This is a different category of risk, but I think if you're patient, you probably make some pretty good money with tech going forward.
And patient being?
I think you've got to take a 24-month time frame here.
Okay. Such a pleasure having you on.
My pleasure, Kim.
Thank you so much. Bob Gorman, Chief Portfolio Strategist at TD Wealth. All right, stay with us. When we come back, we've been touching on what's been happening with oil, and we're going to take that conversation and shift it a bit out west and try and understand the impact on Alberta and specifically Albertan real estate. We're going to take a look at why Calgary housing prices may be vulnerable right now. You're watching Money Talk. We'll be right back.